How's it going, guys? My name is Jared Ace and welcome back to Money Met Aish. So you've heard about EasyEquities and you've decided to download the app. But the problem is you don't know anything about the app or investing in the stock market. Fear not, we are here to guide you step by step along the way. But be warned, there are going to be a few truths that you might hear in this video that you might not be happy with. This video will guide you in how to build a strong foundation that will allow you to build for long-term success in the stock market. There's a lot to cover and very little time, so we've decided to, once again, do it in a series. So, if you know somebody who can benefit from this video, please share it far and wide and get a pen and pencil. Hit like and subscribe down below, but also please remember that my videos do not constitute financial advice. I'm not a financial advisor. This is not financial advice. This is a blank cup. Blank cups. Put your logo on my cup. Let's get to work. So you've downloaded the app already and you've joined some Facebook groups. But now what do you do? Firstly, right off the bat, let me just say that the stock market is not a substitution or a savior for general poor financial habits. In the same way that reading Rich Dad Poor Dad once, but still going out and blowing thousands of rands every weekend, is not going to help you succeed financially in life. And don't get me started on Robert Kiyosaki. I've seen the man live, I'm not a fan. But anyway, just because you're able to do something doesn't mean you necessarily should do that thing. And it's the same with investing in stocks. Just because you can doesn't necessarily mean that you should right now. Maybe in the future, but maybe not yet. We're going to have a look at a couple of things to consider before investing and also look at some alternatives which might have a greater financial impact on somebody's life than just chucking a couple of $100 into a Venge stock and hoping that the price of the share goes up to $1. Hope is not a strategy. I believe in all things the best place to start is the beginning. And so we are going to start at the very beginning. Apparently it is a very good place to start, according to Julie Andrews. So, in the stock market, the beginning should be a question that you ask yourself. Should I invest in the stock market? And we have a couple of other questions which you can answer to help you answer that one big question. If you answer yes to any of these following questions, then perhaps investing in the stock market might not be the best option for you right now. Like I said, maybe in the future, maybe at a later date, but you need to crawl before you can run, so maybe right now it's not the best idea. Question number 1. Do I need this money to live on? Dave Ramsey speaks about the 4 walls, and we really love Uncle Dave here at Money Met Aish. And those are the 4 most important parts of your budget. And they are food, utilities, shelter, and transportation. They together make up the most important part of your budget. And if you don't have a budget, there's a link down below to a story we did on Instagram about how to make a budget for yourself and how we do our budget. Go get yourself a budget. Sit down, do your budget right now. You need a budget. Preferably a zero-sum budget. But you definitely need a budget. If yes, you might need to find another source of income before you can start investing, since you don't have any extra money once you've budgeted for these expenses to put aside for investing. The stock market is a great way to have your money work for you, and it's also a great way to beat inflation, but it isn't a substitute for gainful employment. And it isn't going to pay you a monthly salary the same way that a job does. Increasing your income through perhaps a side hustle will give you some extra money if you don't increase your expenses as well, which then you can put into investing. However, if you answered no, you don't need this money to live off of, great. Let's go on to question number 2. Question number 2. Do I have any high interest debt that I currently owe that doesn't include my bond? That could be any debt that you owe any company or any institution, be that credit cards, store cards, personal loans, car loans, any kind of loan, any money that you owe somebody else that you are paying a high interest rate on. I asked the Money Met Age audience on Instagram what their respective loans were and the interest rates that they were paying on those loans, and it was not surprising at all that most people had no idea what sort of interest rates they were paying. And I say it's not surprising because when I was looking for average interest rates, you won't believe how absolutely difficult it was to find interest rates on things like store cards, car loans, or with a lot of credit cards where they offer a personalized interest rate, which is just, in my opinion, a fancy way for them to charge you a lot more and you not know what your friends are paying as well. They also make it far more difficult for you to know what you are actually paying on your debt. So, let's have a look at what I did find. The average credit card interest rate that I could find in South Africa sits between 17 and 20%. And to put that into perspective, the Satrix JSE Top 40 since inception, since its beginning, has returned 13%. While the Signia S&P 500 since its inception has returned 15%. So, even if you are investing while you still have this debt, your debt is charging you a higher interest rate than you could hope to make while investing. So you're actually just wasting your time if you are focusing more on investing than in paying off your debt. Now, some people might say, it's gonna be prescribed debt in 3 years, It's not. Trust me, credit card companies are not going to just let your debt disappear into the night. If you have made any recognition of that debt, if you have paid any amount to that debt, it is not going to qualify as prescribed debt even in 3 years. If they make any attempt to claim that money from you, it will not disappear. Pay your debts. I once said this to a woman on Facebook who asked in an EasyEquities group what she should do with an extra 1,000 rand that she had. And when I suggested to her to pay off her debts, she got really angry and asked me if I work for a credit bureau, and I said, no, it's just the responsible thing to do. She then told me that it was the company's fault for giving her the credit in the first place, which is ridiculous. It's stupid to think that way, for two reasons. Number one, unless someone is holding a gun to your head and making you buy shoes and jeans at Truworths on your Truworths account, it's your fault. You spent that money. Just because somebody hands you a gun doesn't mean you need to shoot it. Okay? So if you spent that money, you have made an obligation with that institution that you will pay them back. And secondly, as investors, we should want our companies to be in a good financial standing. And that is not going to happen if everybody has that same attitude. Imagine if every company that deals with the company you own shares in just decides, we don't care about this contract, we don't care about paying you back, we'll take out a whole bunch of debt and we don't have to worry about paying you back because 3 years it's gonna disappear. No. You won't have a business for very long and your investment is going to fall through the floor. So, if you have any high interest debts, pay that off first. If you don't have any debts, great. We can go on to question number 3. Question number 3. Is there another opportunity that is going to pay you a potentially higher return on your investment than the stock market? The stock market is often beaten by different asset classes, be that vintage cars or wine or champagne or all sorts of old things that people buy, even sneakers. Sneakers often outperform the S&P 500. So it is not surprising that there are other avenues or different things you could put your money in that do actually beat the stock market. Warren Buffett, who is widely considered the best investor of all time, often is quoted as saying that the best investment you can make is in yourself. And often going back to school or learning a new skill through a course is going to give you far higher earning potential than just putting your money in an index fund or trying to time the market through individual stocks. The same can be said about investing in your own private business venture. If you know that if you take a certain amount of money and you buy a couple of chickens, you can sell an egg for a certain amount, you might end up with a higher return on investment buying those couple of chickens than you would buying a couple of really terrible stocks. If there is an opportunity for you to invest in your own knowledge or in a personal business venture instead of investing in the stock market, you should take that opportunity if it is going to return a higher return on your investment. If you don't have an opportunity like that, then we can go on to the fourth and final question. Question number 4, do I need to put any more money in my emergency fund? We've spoken quite often about emergency funds on this channel and their importance. And once again, we look to Uncle Dave for guidance. Your starter emergency fund should be at least 1,000 Rand. It can be more. Obviously, the more you can put into it, the better. But if you can only start out with just saving that 1,000 Rand, take 1,000 Rand and put it away. Not in an investment, not in a call account that's going to require you to give many days of notice before you get that money. Put it somewhere where you can have access to it in an emergency. That's what it's for. It's for emergencies. Once you have got your baby emergency kit, you've paid off your debt, you can start working on building up your emergency fund of 3 to 6 months, depending on your personal preference, 3 to 6 months of your expenses. And we've all seen in the last 2 years just how quickly everything can disappear. It reiterates just how important your emergency fund is. If your emergency fund is fully paid up and you've got at least 3 months of emergency fund in your bank, then that's great. We can move on to the next part. But if you haven't got that yet, then focus on building up that emergency fund before looking at the stock market. Keep in mind that the stock market is not a substitute for gainful employment. And in order to earn a livable wage from your investments, you either need to have built up an incredibly large portfolio over time or have started with a really large amount of money. In order to get 1,000 Rand a month in dividends from an average 3.5 to 4% yielding company, you would need roughly 300,000 Rand invested in that company in order to get that 1,000 Rand a month. Now, 1,000 Rand a month is not a livable wage, so you can only imagine if you had to multiply that by 5, 10, or 15, how much you would need to have invested. It is a great way to have your money grow and to outgrow inflation, but it is not a substitute for a job. So, this has been a pretty hard-hitting video. There have been a lot of truth bombs going off, but we've made it through and we're able to answer question number 1, should I invest in the stock market? If you have come through the other side and your answer is yes, then join us next week when we look at what exactly we look at when we pick stocks and ETFs to invest in, as well as what kind of questions you could ask on online platforms to get better answers and better responses to your burning questions. So, if you have liked this video, if you have found it useful or helpful in any way, please hit the thumbs up, please subscribe down below and ring the bell to be notified anytime we upload new videos. You can also catch Money Met Aish on Instagram and Facebook and everywhere where Money Met Aishes are. Thank you so much for watching and good night.